All right, we're going to get started. Hello, everybody. I'm Gabriel Metcalf. I'm the CEO of the Committee for Sydney. Welcome to today's Committee for Sydney live event where we will discuss Australia's budget. To begin, I would like to acknowledge and pay my respects to elders past, present, and future. I am broadcasting today from the traditional lands of the Gadigal people who occupied this part of Sydney's coast. Last week's budget was a very big deal for many reasons, but centrally because we are in the middle of a global recession, which many people are comparing to the 1930s in its scale and impact, and the budget makes up a big part of the response. Paraphrasing what the committee said in its response the next day, we said that it's a good budget, not transformative, and in a way, I suppose, displaying both the virtues and the limitations of cautious incremental competence. As the dust has settled and everybody's had a chance to understand beyond the headlines what's really in the budget, we have today gathered some leading economists to talk about both the good and the bad of the budget. So to start us off, Joe Masters, who is EY's chief economist, will provide the overview and some initial commentary. Following, we will turn to Ivan Colhoun, chief economist of markets for NAB, and Brendan Coates, the household finances program director for the Grattan Institute. So we have, as you can see, a quite wonderful panel. Those of you who have tuned into these know the way it works. After we hear from all of them, you can submit questions via the Q&A app on Zoom, and I will sort through them. I've had some show up in email already. Thank you for joining us. Joe, let's start with you.
Fantastic. Thanks, Gabrielle, and good afternoon, everyone. Fantastic to be here to talk about what is truly an unprecedented budget. I'm just going to share my slides, which hopefully everyone can now see. So look, truly an extraordinary budget, but in our mind, not an inspiring one. There was little in terms of policies that had not been flagged or pre-announced. There was no bold reform. We would give a tick to the government's handling of the initial shock, but this budget is asking a lot of businesses and consumers to drive recovery. And the largely temporary nature of a lot of the fiscal measures means that that ask requires confidence. But we're asking for that confidence without any accompanying long-term vision to shape the future of Australia. So let's have a look at the detail, a chart that's familiar to all of you. The deficit is expected to be $214 billion this fiscal year. That was pretty much bang on expectations from economists, and $112 billion in fiscal year 22. And together, over those sort of forward estimates, we'll see government net debt reach 44% of GDP by mid-2024, which is just a little bit more than double where we were sitting prior to the COVID-19 shock. There is no doubt that they are big numbers. But there's also no doubt that the economy needed support, needed those big numbers in the face of such a deep, broad, and global shock. So this slide shows two charts from the budget papers which illustrate the impact of policy stimulus. The blue line is for growth and unemployment forecasts before any policy announcement is taken into effect. So had we done nothing, that is what our world would have looked like. And the purple line is the government's estimate of the impact of the range of policy measures that they've put in place since March. As an example, the peak in the unemployment rate is now expected to be 8%, not 13.3%. And that's a big difference when you consider that people feel recessions not through GDP, but through the jobs market. And of course, the good news is, and we've heard this before, that this is money that we had to spend. This is money we should have spent, and it is actually money that we can afford. Despite the focus in recent years on paying back deficits, paying back debt, this is money we can afford. The RBA has ensured that interest rates are about as low as they can get, and they will remain low for years to come. Now, as a result, even with a more than doubling of the stock of debt that the government will hold, and you can see that in the bars in this chart, the cost of servicing that debt is expected to be just 0.7% of GDP per year. That's about 1/3 of what was paid after the last recession in the early 1990s, and less than the servicing bill after the GFC. Now, as always, the fiscal outlook is a combination of policy announcements, which tend to be where the focus lies, but also the underlying assumptions. Now, in a typical year, economists would focus on the Treasury's forecast for nominal GDP, which, as we know, is a big driver of government revenue, wages, iron ore assumptions, and the like. We all know that this is not a typical year. So this year, a lot of the focus on the underlying assumptions was around what the government is expecting for population growth, which is what we've got in this chart, border closures, and vaccine or health response. Now, not surprisingly, given that our international borders are closed, the budget assumes negative net overseas migration over the next 2 fiscal years, and the weakest population growth in over 100 years. And of course, remember that population growth has been a big driver of Australia's economy over the last decade or so. So such weak population growth numbers does present a near-term challenge. Just consider the impact on the number of dwellings that are needed, whether they are owned or rented. And remember that retail sales per capita was declining prior to COVID-19. To me, though, the big issue is not what happens in the next year or two while our international borders are closed, but more what you think will happen in the medium term as our borders reopen. My guess is that Australia remains a very favourable destination for skilled migration, that it returns to being a positive for our economy. And the government's forecasts also have a fairly significant rebound, although even out at 2024, not quite back at pre-COVID levels. Now, the budget also assumed a population-wide COVID-19 vaccine program for Australia is fully in place by late 2021. And that's been one of the biggest questions in the post-budget events that I've done. Is that reasonable? At the end of the day, you can always disagree with underlying assumptions. I would say this one is contestable, but to be fair, not unreasonable. And most importantly, the government has shown a willingness to be agile in its policy response in the face of changing underlying economic or health conditions. And I suspect that remains the case. And of course, even in the budget, there was some scenario planning around what would happen should that vaccine plan take longer than we expect. So what was the government's strategy? Well, it's a focus on jobs and creating the settings to get the private sector back on its feet, largely, as this chart shows, through tax measures, income support, and subsidies and grants. It's not a strategy that sees a greater role directly for the government in the economy. Now, on jobs, there is a pivot towards creating jobs that have a future and weaning the economy off expensive life support, JobKeeper. The speed and timing of that is a pretty tricky balance. In terms of directly supporting jobs, the centrepiece was the JobMaker hiring credit aimed at young Australians and the apprenticeship wage subsidy. Both, of course, have come under fire for leaving females behind, even though we know that females, alongside young Australians, have been at the forefront of labour market disruption. And as this chart shows, spending on subsidies and grants is playing a big role in the current fiscal year. Now, the real strategy behind jobs is actually to get the private sector moving. And there's two prongs to that. The first one is supporting households by boosting their income through bringing forward of the second stage of the income tax cuts, extending the LITMO for another year, and two targeted $250 direct payments. One of the things that was missing, of course, was any announcement about job seeker rate going forward. The second prong was to support business investment and cash flow, with the key policy a generous but temporary instant asset write-off for companies with a turnover of less than $5 billion. Put that in perspective, that policy is bigger in dollar terms than the household income tax measures. And of course, the government also announced the temporary loss carry back measures. Treasury estimates that these two measures will deliver nearly $32 billion in tax relief to the business sector. While that's helpful, it does help the economy, but it's largely in a cyclical sense by supporting cash flow when times are tough and bringing forward business investment. There was also a range of initiatives around red tape, regulation, skills, digital, R&D, and that will help with some of the structural challenges. But to me, it felt more piecemeal than a central, targeted, big, bold strategy. And of course, there was a focus on some specific sectors, advanced manufacturing, for example, which will have to work hand in glove with the focus on training and reskilling. There was not a lot, at least relatively speaking, in the way of direct spending, things like infrastructure and government services. Of the nearly $90 billion in new measures announced since the July fiscal update, less than 1/4 of that over the next 2 years is direct spending, which is what you can see in those dark blue, purple lines on that chart. The chart also highlights that there is an expectation, or maybe a wing and a prayer hope, that by 2023-24, the private sector won't need a lot of support. Indeed, if we step back, the broad plan is for government spending to support the economy while the private sector makes the most of temporary measures to get back on its feet, drive activity and job creation. This chart shows the budget projections for private final demand and public final demand, and it really illustrates that point. If it works, this budget strategy will be a true example of a private sector driven recovery rather than government intervention. But history tells us it's going to be a challenge, particularly given fickle and fragile household and business confidence. Households saved 1 in every $5 of disposable income in the June quarter. And while easing restrictions means there's now more opportunity to get out and spend, households are facing into high unemployment, elevated job insecurity, a household income cliff, still high debt, and now an even weaker outlook for income growth, given where we see the labour market. And for businesses to borrow and invest, they require confidence, not just about the future of the economy, but about their own ability to expand, as well as certainty around regulatory settings. And of course, for those businesses that rely on population growth and the movement of people, there is added uncertainty. If you remember, going into COVID, non-mining business investment was already weak. Business credit has now fallen for 4 consecutive months. That means in net terms, businesses are repaying more loans than they're drawing down new loans. And really importantly, as this chart shows, history serves as a reminder that it's no easy task to lift private investment in the shadow of a recession or an economic crisis. If you look at the blue line, it took 7 years from the GFC for non-mining business investment to recover to the same level as it was before that crisis hit. And remember that that recovery happened with the added bonus of a significant reduction in interest rates, a luxury we simply don't have this time around. The packages announced in the budget show a government being careful not to introduce structural deterioration into the budget in the form of large permanent spending policies that also see government play a larger role in economic activity. This is a government looking to provide the settings for a private sector-led recovery. And that's why we called our budget update, which is available on our website, Spend for Your Country. It's exactly what the government is hoping we'll do. But the biggest gamble that the federal government has made in containing this to largely a response and recover budget is that it leaves questions about Australia's long-term strategy unanswered. And it's those answers that businesses are looking for to feel more confident about investing and hiring. A vision of productivity enhancing reform to reduce friction in doing business, investing, hiring, innovating, and expanding. It would be disappointing if the baton of supply side reform is not picked up in the next budget, which is due in May. The list, of course, is familiar to all of us. Tax, skills, industrial relations, red tape, regulation, how we price infrastructure and how we think about it. This budget did little to address productivity, innovation, or a broader lens on infrastructure. And of course, the opportunity to address the lack of accessible and affordable childcare. And that is why it didn't get a tick from us in terms of being inspiring. We do still hold out, though, that the May budget will deliver some of that reform that we feel Australia needs for its long-term economic prosperity, to provide economic opportunity for young and for new Australians, which is so important to lift living standards. So with that, Gabrielle, I'll leave it there.
Great. Thank you, Jo, very much for the overview to get us started. Ivan, let's turn it over to you now for your reactions and thoughts.
Okay, and I'm going to share a few slides as well, I think, just to actually follow on to a few things Jo's saying. But so I thought I'd just, and we discussed this briefly, but what do people want to know at the moment? So this is, Jo's given us some hints of that, but these are the questions that I'm getting asked by everyone. So, you know, it's about what does the economy look like in 2 to 3 years? What happens to the economy after JobKeeper and JobSeeker disappear? So a lot of interest in Australia and China. There's the questions about what might be permanently different, and the most noise about that is working from home and commercial office space demand. What's the outlook for immigration, which Jo mentioned is a very big piece of the near-term economic outlook, and I agree with her assessment about the longer-term outlook. I think Australia will still look very favourable. And then this was really more the budget one. What can the government do? And then there's a little bit of noise about is inflation going to go up or go down, and probably not enough focus on the whole question of do we get a vaccine or not, because in the end, all of the discussions we're having here are all about containing a virus or living with a virus or looking at those questions, because that is the biggest thing that's driving the economic outlook at the moment. So that's what people are asking. I'm going to flick through to my wish list. So I put this wish list together for the budget before we got it, and you'll notice it's a wish list for governments, so plural, and for budgets, because the state governments have a role to play here. And again, coming back to that story, control of the virus or living with the virus, I think, is the number one issue that we have to deal with. And we've seen this in Victoria, unfortunately, and you know, where you don't have, you haven't had the really great testing and tracing capabilities they've put in place in New South Wales. And then I think there's the whole political issue of reopening interstate borders. That needs to happen, in my opinion, where it's safe to do so. And then going a bit further along, obviously, is trying to have those quarantine arrangements in place so we can reopen our international borders and get some of our, particularly students, back, restart the migration program. I think that's really important. And then the other themes, which I think, again, this is how I'm assessing the budget, do they continue to fund the economic bridge, so to speak, for those that are impacted, forces beyond their control, retraining for those impacted? Do they start to support the recovery phase? So these were, I wanted to see them boosting aggregate demand, bringing forward the income tax cuts, measures to boost business investment, bring forward of infrastructure spending. So you can get, start ticking off a lot of these. Do you not waste a good crisis? That's something that governments over the years have done well, and particularly I'm thinking back to Keating and Hawke. I think that's the one you'd probably give them quite a big X on, and Joe's mentioned social housing, climate change, female childcare. And I think the big one is always taxation reform. And over time, we need to have a lower corporate tax rate, lower marginal tax rates, and higher GST, but no one will touch that. And then, again, encourage return to work. I think that's really important in CBDs, and I'm sure the Committee of Sydney would probably share that view. I think to get us back to normal, we have to have CBDs functioning. And if you look at both Melbourne and Sydney, they're lagging, I think, because of their economies are so CBD driven. And then, as Joe said, support should be temporary. So my, I guess, main reflection on the budget is it did quite a lot of those near-term things, and I think it did them pretty well. It didn't do a lot of the big things that you'd like to see from a medium-term perspective. And I just thought I'd finish with a couple of surprises, just in terms of when we're talking about the outlook and recessions and really bad news. I think there's a few things that aren't turning out along that playlist. Now, if you look at retail sales, except Victoria, they're about 12% higher than they were before the crisis. Now, I think that's it's really telling you this is a complex crisis, because the government's given a lot of money, which is helping support retail spending. Services are the weakest part of the economy, and they're not really very well represented in retail sales. People have been able to get access to their super, which some of it is ending up in retail sales, some in car sales, etc. And then you can't travel either, for the most part, even domestically, let alone internationally. So there's money coming into retail sales. So that's quite unusual, I think. The second one is, if I look at job advertising, and that's what businesses tell you. You can see the collapse in job ads when the crisis hit and people stopped hiring. But in 4 of the smaller states, job ads are back above where they were in February. Now, you'd never predict that in a very major recession. Queensland, it's pretty close. It's 10% below. And you can see Melbourne for obvious reasons, but New South Wales, I think this is the CBD influence and these international cities, and Canberra is similar. But in each of these, even in New South Wales, you can see we're continually recovering. So I think things are perhaps doing a little bit better than people might expect. And again, if you look at hours worked, they went down. They're down 5.5%, but Victoria is having a big influence on that. So the rest of Australia's, I'm going to say, only inverted commas down 3, but I think it's still recovering. So probably not quite as deep as it seems. And then the other thing that you wouldn't have expected to happen in a major downturn is house prices hold up. So I'm going to give the budget, my reflection is, for the most part, a pretty big tick in terms of the response in the near term to the crisis. Now, to try and help recovery, but about the medium-term structural and big policy issues, I think that's where you could give them a negative mark, and I guess they would probably respond by saying, we're very focused on the right here, right now, which, that's probably not unfair either. So I'll leave it there, Gabriel. And
okay. Ivan, thank you very much. All right, Brendan, over to you. What are your thoughts and reflections on this budget? And you're muted still.
Thanks very much for that. So look, I'm going to share a couple of slides as well, but I want to start with, I think, just about the most important context alongside COVID, and that's the fact that the Reserve Bank can't do all that much to support the recovery from here. So the interest rates are effectively at the zero lower bound. There is a debate about what more government could, so the Reserve Bank could do, but I think on the whole, no one's really expecting they can turn around and really accelerate the recovery from here. And to put it in perspective, during the global financial crisis, we saw interest rates fall by 4.25 percentage points. The Treasurer has said in some of his public statements that was equivalent to 100 billion in stimulus, fiscal stimulus. In comparison, during the COVID recession, we're seeing interest rates fall by 0.5%. So what that means is, one, there is an enormous amount government can do. Two, the multipliers, so the bang for your buck in a time when you're not going to get any sort of offset from the central bank, is very high. And three, that support might actually be needed for longer than we would normally expect, because the drivers of that decline in long-term real interest rates, an aging of the population, both in Australia and around the world, questions about inequality, falling productivity growth, it's not clear that a lot of those things are going to change anytime soon. And that also has the effect of suggesting that if interest rates are going to remain low globally, then the borrowing rate, the rate at which the government can borrow, will also remain low. So if we think about what the actual budget itself included, so I've missed a slide here, it seems. Here we go. Most of the government's spending, I think, as Joe said, the stimulus is very large in this coming financial year, but it tapers off very quickly. So this is breaking it down into changes in the budget outcome compared to previous Treasury forecasts. The orange bar there is spending policy. The yellow bar is revenue policies. A big announced fiscal stimulus in 2021, but it fades very quickly. So by 2022, 2023, we're not really seeing much of an impact of fiscal stimulus on the economy. And in fact, in 2024, decisions taken since the last budget are actually a net positive for the budget bottom line. So they're taking out more money than they're putting in. And the reason I think that really matters is because it's unlikely the Reserve Bank's going to be able to do a lot in the short term. And if it is a long, fairly drawn out recovery, that means that we don't see unemployment come down as quickly as what we would like. And in fact, that's what we see, as Ivan has suggested, it's looking like it's going to be better than what we previously thought. The peak in unemployment is going to be lower, but we're not expecting unemployment, which is the yellow line here in the budget, to really fall below 5.5% until mid-2024. That's obviously assuming a vaccine comes next year, which I think is the most reasonable expectation. But it's worth remembering 5.5% unemployment rate, which is what we had roughly before COVID, saw no real wages growth for something like 6 years. Is that really what we're aiming for in terms of the recovery? We've already seen that inflation has been well below target. The unemployment rate has been, below expectations of what full employment is. So the Treasury expects it's 5%. The Reserve Bank pre-COVID suggested something between 4 and 5%. So you shouldn't be expecting to see a wage rise until unemployment gets down to 5%, really. And by it not being below 5.5% to the end of 24, it suggests we're not going to see anything in the way of real wage rises for effectively a decade. So and in that context, the recovery from COVID is on the forecast expected to be slower than most economic recoveries we've seen from other recessions in terms of the decline in unemployment. So we look back at the post-Keating recession, 1992 to 1996, as having been a failure of macroeconomic policy broadly that inspired the kind of policies we saw during the global financial crisis. And that sees a faster decline in unemployment in percentage points per year than what we're expecting in the COVID recession, when, of course, a lot of the COVID recession is being caused by not just the virus itself, but also by government measures that constrain economic activity. And you'd anticipate as those are lifted that we should see that recover quite quickly. But in fact, that's not what we're seeing. Now, just very quickly on the measures, and I'm going to jump here a bit because I just prepared for what I thought we might come up with. I think it's worth pointing out that as Joe mentioned, it's focused on the private sector. So we're expecting a private sector-led recovery. But the sort of discretionary industry-specific stimulus is also not really well targeted at the sectors that have been hardest hit. So we're seeing lots of spending on construction, something like $15 billion in the budget, whereas that sector has lost far fewer jobs than many others like arts and recreation, hospitality and the like. And we're seeing a fair chunk of extra spending in the budget on things like utilities, which we know are not particularly employment intensive. So there's a real missed opportunity here in terms of having done more directly to support employment by funding the sort of social services that are going to be needed on the way out of COVID, for targeted support for households, to support those sectors that have been hardest hit, so hospitality, tourism. You know, the Northern Territory's done a tourism vouchers program. We could have seen something similar. Missing the, not announcing the permanent rate of job seeker or our extended temporary rate of job seeker was a real mistake in the context that that's probably the most effective stimulus you could do. It would provide a lot of support for households, and we haven't gone there. The same with social housing. You know, these are the kind of policies that should be at the top of the list in terms of stimulus, and it's quite striking that they've been left out of the budget for now. And then obviously the focus of the ALP's response has been the childcare subsidy reforms, which we think are actually one of the best things that we could do. It'd be one of the most effective ways we could boost workforce participation, which is going to need to be a priority coming out of the crisis. And so ultimately, I think our assessment of the budget is, look, a very substantial stimulus in year one, probably not weighted to the kind of things that we would expect would give the biggest bang for the taxpayer's buck in terms of boosting the economy. It suggests more would be needed. We think a reasonable aim should be to hit unemployment of 5% by the end of 2022. You know, that wouldn't be out of line with past recessions. That would also see wages growing up, frankly, 2 years earlier than otherwise would be. And I'll leave it there.
Okay, thank you very much, Brendan. All right, really interesting set of ideas there for us to think about. So everybody, please feel free to submit questions via the Q&A app. So let me just start. You've all, I think, similarly said it does a pretty good job at the short run, but it is missing the big opportunities for reforms. That seems to be the consensus. So maybe a two-part question to get us started. First of all, there's going to be a New South Wales budget coming out next. What would you hope to see in the New South Wales budget? What would really make you think the state was doing the right thing to build on what the federal government has done? Second, because this budget came out late, it's not all that long till the next budget in May. What would you like to see in the May federal budget? And maybe I'll just pose that to you in the order that you spoke. So Joe, your thoughts on those two questions. You're muted, Joe.
Sorry about that. You think we'd all be all over the mute button by now. So I guess the first thing when we, as we head into these state budgets, is to acknowledge that it is easier for the federal government to raise debt at a cheaper rate. So I do think compared to previous years, we would like to see more federal state, I guess, collaboration. We would have liked to have seen more in the federal budget that made it easier for the states to do the jobs that they are tasked with. Having said that, what would we like to see in the state budget? Look, the wish list is really long, of course, but certainly I think there are two things that are really critical. One is, to what extent can the states continue to try to support the economy through this respond and recover phase? So to what extent can we see increased spending on the services that states provide? and ongoing relief to the extent that it's needed to try and get through this initial crisis phase. So things like sort of payroll tax relief and the like. Some are working really well. I mean, we've seen in Friday's lending data, for example, for the first time since 2009, a greater dollar number of mortgages go to first home buyers than investors. So there are policies that are working, but there's probably areas that need ongoing support. The big one for me, though, is probably infrastructure spending. As I said, we didn't see a huge amount of direct spending from the federal government. Our own research at EY shows that compared to things like bringing forward the income tax cuts or even a permanent increase in job seeker, that direct infrastructure spending is very effective at bringing down the unemployment rate, which is ultimately what this government strategy is all about. And I guess we'd like to see not just big transport projects and not just bringing forward of the so-called shovel-ready projects, maintenance, health and safety regional projects, but as Brendan said, social housing is one, energy is one that requires a bit of federal government intervention as well, but also digital, something you and I talk about a lot, Gabrielle, digital innovation, and of course a green and sustainable climate lens to the extent that that's around as well. So more direct spending from the states to the extent they can fund it, and support from the federal government to enable them to fund it in the most cost effective and cheapest way possible would be my shout out.
Okay. Ivan, how about you? Thoughts on either the New South Wales budget or the May Australia budget?
Yeah, look, I'll just echo Joe's comments about the New South Wales budget. So it is easier, I think, often for the states to find infrastructure. So I think that seems obvious. Payroll tax, yes. I think Brendan also made the good point that a lot of this should be targeted. And, you know, some of the areas that have been hardest hit are quite small businesses, services side, and a lot of the responses have been quite broad. And as I showed you with a couple of slides, there's, you know, it's a very complex shock because there's a lot of spending that's up very, very sharply. In our data, I think it's flower sales are up 70% year over year because no one's traveling, right? So they're sending flowers to their poor elderly relatives locked in aged care homes, or, you know, if it's a wedding or if it's a, you know, significant birthday. So not everyone needs support, and I think tightening targeting is there. As Joe said, social housing, that seems an obvious one. All the modelling says housing construction will slow. So the housing construction sector will need some support. Let's get a win-win out of this and try and provide a bit more for social housing. Again, it doesn't have to go too far in your thoughts about if we need to give further stimulus. Let's try and do something on the climate change front as well. So I'd say all of those make sense. I would give a positive call out to the New South Wales Treasurer, who has been talking about GST reform. You know, so he's thinking about that, but obviously it's still not going anywhere. But he has been thinking about that. In the May budget, I think hopefully we might see some more of these medium-term issues perhaps addressed if we still need them. But I think really the budget should be appropriate to the evolving circumstances, and May is still quite a long way away. So let's see what it looks like when we get there. I think the government has been flexible and it has responded as things have developed. And one point which hasn't come up yet, but the income tax cuts that have been given, I think that a lot more of those will be spent than this time last year, because they're dripped into your pay every fortnight or every month. So I think you'll see that does have a positive impact on the economy.
Brendan, how about you? Thoughts for New South Wales or for the May Australia budget?
So focused on New South Wales, I think the obvious one is social housing. The reasoning is pretty simple, which is to say that we like to think about infrastructure being, you know, a way in which we try to stimulate the economy. It provides like a long-term benefit to the economy at the same time as being short-term stimulus. But it's much easier to build a 4-story apartment building than to try to, you know, build a tunnel under a river or under the harbour. And so we saw during the global financial crisis, it was very effective as stimulus. And so we are seeing substantial job losses in the construction sector. I think there was some forecasts from McKinsey a little while ago that said something like 150 to 200,000 people employed in construction, which I think is 12 to 18% of all workers in that sector, could have lost their jobs by March 2021. Basically because the pipeline of high density residential construction is already coming down. And the kind of things the government's done, like Home Builder, may be effective at the margins in supporting greenfield construction, but they're not going to do a lot for apartments, in the inner and middle ring suburbs. And as much as we might have lower population growth in the short term, we should also see this as an opportunity to try to fix that demand supply imbalance that's occurred and get house prices and rents down as fast as we can. So other forms of infrastructure, particularly transport infrastructure, I'd be a bit nervous about, particularly because we've seen this huge trend towards mega projects, projects that are worth $1 billion or more. And they tend to be very slow to roll out, and they're very likely to have cost overruns, such that the benefits of the projects versus the cost has often been called into question. And so as far as stimulus goes, that's the area where I'd be a bit more nervous if we try to launch a new round of infrastructure projects, particularly when we don't know what the underlying dynamics of settlement and work are going to be, where people are going to choose to work.
Okay, really interesting. In terms of tax reform, what's the most important of all the ideas that are circulating out there for let's at the federal level? Maybe let's do this one in reverse order. So start with you, Brendan. If the federal government had to pick one big thing to do on tax that would help with long-term economic growth, what would that be?
Well, let me start, Gabriel, by saying the first thing that they should be doing is supporting the states to do a stamp duty property tax swap, because I think that is the thing that would make the biggest difference to the economy. And the costs of that reform in the short term are quite large to the fiscal position, depending on the model that they adopt. And the Commonwealth will be very well placed to support that. At the federal level, I think the thing that would make the most difference is probably what the federal opposition has in fact flagged. Not necessarily that precise policy, but essentially bringing down effective marginal tax rates for secondary income earners via childcare reforms. We know that labour supply is much more elastic, as in people are much more responsive when they're the secondary earner. You can go from 3 to 4 to 5 days a week. Look, I'm currently employed full-time. You could drop my tax rate and I might work a bit harder, but I certainly can't work anymore, at least not in terms of my paid hours. So we know that's something that would have a big impact. I think Grattan Institute estimated that if we did reform the childcare subsidies, it might cost something like $5 billion a year, but you'd get more than double that in terms of the boost to the economy via increased workforce participation. Because that group is, particularly if you're returning to work after being a mother or a parent, but it does tend to more often still be the mother that's changing, then that's when your labour supply is most responsive. And so that's the reform that I think could be very easy to roll out in the short term, or would have very large boosts to the economy in the medium term. Other things like company tax, corporate tax are worth thinking about if we want to change to a cash flow tax or something similar. But they're reforms I think that the government is less well advanced, and it will take them quite a long time to work out what the optimal approach is. And one thing we've learned from the GFC is you do not want to rush these reforms. So Grattan recently said in a report, their recovery book in June, you should be very careful about doing structural changes in the next 12 months. You'll find it very hard to get right. We saw this with the mining tax post the global financial crisis, where frankly a botched design meant that it didn't work in a way that it probably should.
So some skepticism about this notion of not letting a crisis go to waste when it comes to tax reform.
It's about sequencing. It's about when you do it. I think the federal budget next year is probably about the point where they should start thinking about it. If the state government, New South Wales, came out with a very big stamp duty reform, in the budget in the next few weeks, I'd be very impressed, but I'd be very worried that they might not do it well.
Okay. Ivan, to you this question, on the subject of tax, what would have the biggest impact?
Well, look, I think everything Brendan's said are definitely worth considering. I've been thinking more about, as I said before, rebalancing the mix at, in the longer term between company tax rates, income tax rates, and consumption tax. So I think that needs to happen longer term. I personally am more in favour of continuing to cut income taxes at the moment than company taxes, because I think really when you look at the share of income that is accruing to workers, it has been on a longer term trend decline, and companies are not giving big wage increases. There are other reasons for that, but wages have not been growing, and also companies haven't been investing as much. So I think if you were giving income tax cuts, that money, I do believe, will be recycled into the economy, and that will have a benefit for companies as well. But that's sort of more a macro perspective on tax than particularly some of the more micro stories, I guess, that Brendan's talking about. So I'd like to see income taxes cut and provide that incentive to work harder and to find jobs.
Joe, your thoughts on tax? What would have the biggest impact? And you're still muted.
Sorry. So, I think there's two issues on tax, right? The first one is, what can we do with our tax settings to help the response and recovery from COVID? And the second one is, what do we need to do for our economy over the long term? The first one is, as Ivan said, a lot of sort of micro, particular individual measures. The big one, around what do we need to do for the future, I often make the point, you'd be hard pressed to find an economist that wouldn't argue for a higher GST and a broader base. The reality is, though, we're a country that's been talking about tax reform for a long time. We've had several significant reviews, spent a lot of money, some very smart people. I feel like to some extent, we all know what's on the table. It's actually more a question of what is politically achievable and palatable, rather than what does economics tell you is the way forward. And I think the reality with tax is it's never one policy, because it's a complex ecosystem and all of them have intended and unintended consequences. So we need to look at the whole framework if we're looking at longer term support to generate economic opportunity for young and new Australians.
Okay. Some people have been asking about how the economy is likely to change permanently on the other side of COVID, which I think is an interesting topic. It's probably a truism that recessions in general do cause permanent change. Psychologically, everybody wants to get back to the way things were, but a lot of jobs are destroyed that never come back. And so when the economy gets to growing again, it's not in the exact same way. Some people have pointed out that Australia is out of practice with this because it skipped the last recession after the GFC. So perhaps Australia could be due for even greater structural adjustments than some other countries. I don't know if that's true or not. This is obviously a crystal ball. No one knows for sure, but would be interested in your thoughts about what might be some of the permanent changes that we see. Brendan, let's start with you on that.
Thanks, Gabrielle. I think it's interesting. There was one recent study out of the US that said that they estimated 42% of the initial layoffs in the United States were likely to become permanent. So we're going to see an acceleration in that structural change. I think if I could just talk specifically about what it means for cities, I think the big changes there are probably, even if we've now been going through this for long enough, and look, I'm speaking as a Victorian, so we've been going through it the longer than most, that you're going to see at least some longer term shift to working from home. So the trend seems to be in the surveys that we've seen that it's not that everyone's going to work from home all the time, they're just going to work from home more. So a lot more people work from home 2 to 3 days a week. Look, I've got a 3-year-old, well, actually no, a 4-year-old as of last week, and a 1-year-old. I can tell you that it makes a big difference to be able to work from home rather than trying to get into the city every day and balance childcare. And I suspect that that's going to stay. And so what that means, I think, is less demand for office space for straight up offices and more space for collaborations. And we should be thinking about how to design our cities in a way that achieves that. I think it means that people need more space at home. So you're likely to see a sorting of what people want in their homes. So more extra bedrooms. So the extra space, you know, we're lucky to have a very small annex to our little 3-bedroom house that makes all the difference in the world in a COVID era. But I could imagine having a larger space going forward. And I think what that means is probably larger dwellings. So when we think about the apartment stock that we're building in Sydney, it's largely 1 and 2 bedrooms. That's probably going to turn into 2, 3 and 4 bedders. And I think that's going to be a challenge about how the planning system works, how bank finance and off the plan sales work, because at the moment, very few of those actually are built. We're mainly building 1 and 2s, not building 3 and 4s. So I think if we think about, say, the planning system, it needs to be flexible to a range of different scenarios, because at the moment we just don't know quite what the answer is going to be.
Okay. Ivan, any thoughts on long-term changes we may see coming out of this?
Look, I'd agree again with what Brendan said. That's the biggest noise has been about working from home and office space. And I think, you know, a really good point there was that, you know, some of the people that drop out of the workforce to raise kids, and predominantly female, but not exclusively females, I think there's a great opportunity to keep them more attached to the workforce during those child rearing years these days. So that's been one of the big positives out of this Zoom COVID crisis, I guess. I think though the shorter this lasts for, the less long-term structural changes there will actually be, and people will go back to doing what they wanted, you know, previously did. And certainly once it's safe to travel internationally, people will be travelling internationally again for holidays, to visit friends and relatives, to go and talk to their customers. So those sorts of travel, I think there'll be a little bit of business travel where we don't do as much as we did, and we can do great sessions like this one quite efficiently. But I think in the end, it's never quite as good as, you know, if we're on a panel in front of your constituents and they were asking questions from the audience. It's just, I think, a better setup. This is certainly a great alternative, but it's not quite as good, I don't think.
Joe, thoughts on long-term changes?
So totally agree. How and where we live, shop, exercise, work, play, eat, all need to be considered. I'd probably call out 2 different ones, though, that are in addition to that. The first one is, I think we could see some greater corporate concentration in key sectors in our economy. And we need to think about what that means for the structure within those industries. And by that, I mean, we know that small and medium-sized businesses just have a harder time staying solvent through this period. Now, they're being protected at the moment, but that won't last forever. And we are already seeing in some sectors in Australia, you know, mergers and acquisitions that will see this sort of greater corporate concentration. Mining's a classic example, but not just in mining. And I think as we tighten up those sort of insolvency laws again, and as JobKeeper comes to an end, those opportunities will present, and we will see that. The second one is, to some extent, we will see greater government involvement in the economy and in our capital markets. And that also potentially has lasting and structural changes in the economy. The third point I'd like to make is one around, and Ivan sort of touched on this, on what doesn't change. 3 big strengths to our economy have not changed in the face of COVID. They may have been disrupted, but not changed. As I said right at the very start, I still believe we are an attractive destination for skilled migration. The rise of the middle class through Asia remains a key trend for Australia. And our deep comparative advantage, not just in resources, but in things like ag and food tech, med tech, waste, renewables, to name a few, you know, those are things that we can continue to exploit, that we can exploit more, that we can add more value, create more jobs. And we absolutely need the policy settings to allow that.
All right, following up on this, this might be the last question, but somebody just emailed this to me. More working from home, We don't know exactly how much, but kind of universally predicted. Is there any risk that the innovativeness of the economies of Sydney and Melbourne will be eroded? All these years of people making the argument about the benefits of face-to-face agglomeration, if that is actually true all these years, is there a risk that there will be a long-term decrease in either innovativeness or productivity in the knowledge economy? Anybody want to venture a thought on that, Joe?
I'll jump in. Look, no one knows, right? And work from home can look in lots of different ways. I personally don't believe that CBDs and cities are no longer desirable, and that there will be, a significant trend to moving out of the cities and working entirely from home. I think, we've heard RBA Lucy Ellis talk about, don't underestimate the wish to kind of get back some of what we thought of as normal. I myself am back in the office a little bit. I can see Ivan's in the office. The days that I'm in there, I've got team members coming in, we're collaborating. We were all in the office for budget night, which was a very long and intense experience, and we really benefited from that. So I do think if you did get significant wholesale working from home, people moving outside of cities, you do lose innovation. I personally don't think we'll see that.
Ivan, Brendan, any thoughts on that? Any risk of a less innovative or productive economy from reduced agglomeration?
No, I don't think the long-term impacts of that will be quite that big. I think the impact is going to be larger in the short term on those businesses that just require people to be in the CBD. So if you see 20% less people in the CBD and you're planning to rent out an office space, like, life's going to be pretty tough for you. You're going to accept a lower rent. You're going to have fewer customers for your cafe or for your services business that relies on people being in there. But I think in the medium term, no. There's some good work that suggests that for, say, younger workers, one of the main benefits they get from working in a big office is it's learning. Something like 1/10 of their wage is actually through the learning opportunities that arise from being around high-skilled, high-paid workers. So if I think of my own team, it's younger staff that you need to have office time for. I could probably work remotely for quite a long time, but they will lose a lot, and you'll develop your staff much less if you can't do that in person.
That's the one I think about as well, Gabriel. It will be getting the balance right, and it's harder to run projects where everyone, some parts of a project are easier to run where you're not being interrupted all the time, so you can focus, and then the other part where you actually have to sit around and throw ideas around. It's very hard to do on Zoom when, 7 people are trying to talk at about the same time and you end up stopping. So I think there'll be a mixture. It'll be a hybrid model for working at home. There will be opportunities, and, there were some questions about the housing market. We know people are buying in regional locations because they know they can spend some time outside the cities now and sometime in the city. So it's been a very interesting and, again, I'd say complex shock that we've been experiencing.
All right. I want to thank all three of you for making time for this discussion. Really interesting. Joe, Ivan, Brendan, thank you for following this in such a knowledgeable and perceptive way. It'll be really interesting to see the New South Wales budget and the next federal budget, and track progress. Track progress on this recovery. Everybody else, thank you for joining, and we'll see you at the next Committee for Sydney Live.